Hello, this is Herb Morgan, Senior Managing Director and Chief Investment Officer of Efficient Market Advisors. We are a business of Cantor Fitzgerald Investment Advisors. This is our economic and market commentary for the week beginning Monday, April 30th, 2018. No part of this presentation should be construed as investment advice. It has been prepared by EMA for use with investors and financial advisors who are expected to make their own investment decisions. With that, let's get started. A pretty uneventful week last week for all financial markets. Nobody had even a 1% move, with the exception of the MSCI Emerging Markets Index, which was down 1% on the week. Stocks here in the U.S. were mixed, with large companies at the zero line, small and mid-cap stocks slightly lower. Bonds mostly were bid higher, with the exception of high yield, which seems to have declined in sympathy with mid and small cap domestic equities. Commodities slightly lower, as was the HFRX Global Hedge Fund Index for the week ended Thursday. Let's start getting into some of the economic data released last week. The Market Manufacturing Index rose to 56.5. It said that not only did manufacturing activity expand in the United States in April, but it expanded at a faster pace from the prior month. The services sector of the economy also seems to have increased in April, according to Market, with the PMI there rising to 54.4. With both of these PMIs, any reading above 50 suggests that that sector of the economy grew. In the U.S., manufacturing represents about 15% of the economy, while services is about 85%. We also got a series of data releases last week on residential real estate, the first of which was the March existing home sales report. Came in at an annualized sales pace of 5.6 million units. That's up from 5.4, and of course that's despite an increase in interest rates. However, sales are slightly lower by 1.2% than they were a year ago, when interest rates were considerably lower. We also got a report last week on new home sales for the month of March, and as you can see here from the chart, they came in at 694,000, almost back to that 700,000 level. That's up from a peak after the crisis, which was below 300,000 on an annualized pace. Now, the U.S. needs about 1.2 million homes per year to keep up with the population growth and the formation of households here. But we're still well below that number, primarily because of the years of excess building back before the housing crisis. In terms of prices, the FHFA, Federal Housing Finance Administration Price Index, rose another 0.6%. Now, this was a February report. On a year-over-year basis, we're looking at a gain of 7.2%. So we all are seeing that, of course, the value of our homes. Another report which measures essentially the same thing is the S&P Case-Shiller Home Price Index. It's a broader data set. The FHFA includes fewer homes. The S&P Case-Shiller includes more, so it's seen as maybe a little bit more accurate. That was up 0.8% in February, stands about 6.8% higher than it did this time in 2017. We also got some news on how confident American consumers are from the Conference Board. The April consumer confidence number was higher, 128.7, getting close to those recovery highs. Current conditions rose, expectations component also rose. Solid report all the way around. Moving into the regular weekly initial claims for unemployment, came in at 209,000. This is just incredibly low, but there are some one-time factors in New York that likely depress that number, and it's expected to be reversed next week. So we're not going to call this a series low or a historical low just yet. We'll wait and see what happens. But of course, it dragged down the 4-week moving average and is, of course, positive news for the nation's economy. Moving out further to durable goods orders, we had a big rise in March, 2.6. That's on top of a large gain in February. This, as you can see, though, is a very volatile series. It's big up and downs, primarily driven by aircraft orders, but it's nice to look at the year-over-year trend, up 9.5%. One of the things that's got markets a little spooked, and it's perhaps the reason, despite all this great economic news, that stocks really haven't gone up this year. They're essentially flat to slightly negative, and people are getting more and more concerned about inflation. And of course, the biggest cost for most businesses is the cost of employment, wages, and benefits. And as you can see here, the first quarter of 2018 was reported that employment costs rose 0.8%. That's on top of 0.6 the prior quarter, and now up 2.7% on a year-over-year basis. Now, of course, with tax cuts and a growing economy, this is a sign that good things are happening. But of course, ultimately, that will dip into profits. And so I think markets are just reassessing. Add on to that the fact that the markets ran up so much, so fast in the end of 2017. Seeing a little consolidation here in the first and now into the second quarter of 2018 is likely somewhat healthy in our view. We also got a report last week on gross domestic product. That's the value of all goods and services produced by the U.S. economy. And the first quarter reading was supposed to come in at about 1.9%, according to the consensus estimates of economists that report to the Bloomberg service. However, we came in much better than that at 2.3%. Now, at first glance, you might see that the growth of the economy is slowing because we had 2.9% in the fourth quarter. And I don't think that's true. Consumer spending, though, did slow from a gain of 4 down to 1.1. Business investment slowed slightly from a gain of 6.8 from 6.1. And of course, everybody says, well, gee, the first quarter of the new tax cuts, all these incentives to invest, etc., we expected more. That's true, and you kind of got more because the first quarter has typically been a very slow quarter. This has to do with some seasonal anomalies, which actually the government tries to correct for by smoothing out a lot of numbers and creating these compensation statistics, if you will. But still, the first quarter tends to be a bit lower. As you can see here, I gave you a list of first quarter GDP prints going back through starting in 2010. I didn't want to put 2009 in there. It was such a big negative number. But starting in the first quarter of 2010, you can see that the first quarter has an average of about 1.3%. So coming in at 2.3, which is significantly higher, is certainly seen as a positive. But again, I think there's this issue with wage components, uptick in inflation, all of which are sort of weighing on the market. Uptick in inflation means higher interest rates. It means that the value of stocks is going to be determined by comparing it to a higher risk-free rate of return that you would get from a 10-year U.S. Treasury. Another sentiment indicator came out later. But what's really driving things is earnings, earnings, and earnings. In the long run, markets are driven by the profitability of the companies that are represented in them. And in the S&P 500 index of companies, we're about halfway through the earnings reporting season, and the numbers are really quite good. 266 out of 500 companies have reported. We break it down here for you with the 11 sectors of the U.S. economy. And what you can see is that out of those 266 companies, 207 have exceeded the consensus estimates of the analysts that follow them. Now, to be sure, it's generally the case that companies exceed those estimates. They tend to try to give conservative guidance to the analysts. Analysts try to be conservative. But it's a pretty healthy percentage that are beating. And what's exciting and positive indeed is the fact that the growth of earnings is broad-based and high. Now, utilities only grew at 3%, but utilities aren't necessarily a function of the economy. They're a function of more of the weather. So that was the worst sector. And then you start taking a look at the rest of the sectors. Obviously, energy up big with the new rise in oil prices, but materials, industrials, consumer discretionary and staples, healthcare, financials, technology, telco, And even real estate, which is negatively affected by higher interest rates, returned, high single-digit earnings growth. This is a really great earnings season that we're off to so far. And what's happening is analysts are raising their estimates for the full year of 2018. This chart shows the Bloomberg estimated earnings per shares of the S&P 500 for the year. And as you can see here in the last week or so, as companies report their first quarter earnings, now those are in the bag, and now this number is essentially the real first quarter plus the estimates of the next 3 quarters, and it's continuing to be increased. So that means that the forward PE multiple of the market goes down if the stock market price stays the same, of course. So here at EMA, we kind of think that earnings are going to come in around, maybe 160 for the S&P 500 for the year, and we think a reasonable multiple on that at the end of the year is about 20, which is a little bit lower than the multiple today, but that still puts the S&P 500 at 3,000. That's up significantly from the less than 2,700 that we're at here today. So we still think there's upside in equities this year. Now, we've got a lot of economic data to be reported this week, along with continued earnings reports. We've got March income and spending, PCE, that's the core inflation index, Chicago PMI, and home sales. Tuesday, we've got some market data, both manufacturing and non-manufacturing, construction spending, vehicle sales. Wednesday, we then get into the new month and the reports on employment, which are important. We've got employment estimated from ADP at 241,000. We'll get the Bureau of Labor Statistics report on Friday. That's expected to come in at 185. I think I said ADP was 241. I meant 193. 241 was the prior month. There's also an FOMC meeting this week, Federal Open Market Committee of the Fed. Nobody's really expecting another rate increase here. If that happened, that might be a surprise that could temporarily provide some volatility to the market. Most economists are suggesting that next hike will come the next hike will come not at this meeting, but at the subsequent meeting to that. Thursday, regular jobless claims and productivity, trade deficits, which is a big political potato right now, ISM services, and factory orders. So a lot of data this week, a lot of earnings, and a Fed meeting. We'll see how things develop. As always, thank you for tuning in. We look forward to speaking with you again every week.